right, let's get right to it. Today, we're forging into one of the wildest earnings reports I've seen in a very long time, Opendoor. Look, on paper, the headline numbers looked like an absolute train wreck, a complete catastrophe. But then, in the hours after that report dropped, the market didn't just shrug it off. It responded with a massive, euphoric rally. So how on earth does a company miss its earnings target by over 1,000% and then watch its stock soar more than 16%? That's not just noise, folks. That is a powerful signal. And here at Iron Financial, our mission is to decode those signals, to look past the smoke and mirrors, and help you determine if a company is building a solid iron foundation for the future, or if it's just a house of cards waiting for a stiff breeze. This one is a puzzle. Let's dig in.
Here's our game plan. First, we're going to tackle that central paradox head-on, the ugly headline versus that unbelievable market reaction. Then, we're going to grab our hard hats and deconstruct that massive billion-dollar loss to find out what was really going on under the hood. After that, we'll go deep inside their new operational strategy, something they're calling Opendoor 2.0, to see if the business itself is actually getting stronger. From there, we'll examine their very specific roadmap to profitability. And finally, after we've weighed all the evidence, I'll give you the iron verdict on whether this looks like a genuine turnaround or just a trap for unsuspecting investors.
So let's start with the paradox itself, because this is where the story gets really juicy. This is the moment where the financial news screamed one thing and the actual market did something completely different. If you were just a headline reader, you'd be absolutely convinced this company was in a death spiral. But that strong positive reaction from Wall Street, well, that tells you there's something much deeper and probably much more important happening just beneath the surface. And it's this kind of disconnect that creates massive opportunity, but it also creates a ton of risk.
Okay, let's just put this contradiction on the screen, because when you look at these two facts side by side, it feels like they don't even belong on the same planet. On the left, you have the headline number, and it's shocking. Opendoor reported a net loss of $1.26 per share. Now, just for context, the Wall Street consensus, what all the analysts were expecting, was a loss of only 11 cents. That's not a miss, that's a chasm, a 1,045% miss. In any normal, rational world, a miss of that magnitude should have sent the stock plummeting into the ground. But look at the right side. The reaction was the polar opposite. The stock exploded up over 16% in after-hours trading. I mean, this is the kind of thing that makes you stop, rub your eyes, and ask if you're reading the chart correctly.
And that brings us to the core question, the one we have to answer. How is this possible? How can a company drop what looks like one of the single worst earnings reports this season and get rewarded for it? Is the market just broken? Is this some kind of meme stock madness where the numbers don't matter anymore? Or is the market seeing something real, something tangible and structural that those ugly headline numbers are completely hiding? Is this all just hype and speculation, or is there a legitimate, data-driven reason for this rally? It's our job to find out.
To really get what's going on with Opendoor, we need to deconstruct that billion-dollar loss. That headline number you saw is, to be blunt, incredibly misleading. And to get to the truth, we gotta look past it. We need to peel back the layers of accounting and find the true operational health of the company. We're here to analyze the structural integrity of the business, not the cosmetic, surface-level stuff. So let's break it down, piece by piece.
And here it is. This is the key that unlocks the entire mystery. The overwhelming majority of Opendoor's reported loss, a jaw-dropping $933 million of it, had nothing to do with their actual business of buying and selling houses. It came from a one-time accounting charge related to paying off some of its debt early. The fancy term is a loss on extinguishment of debt. But what you need to understand is this. This has zero to do with Opendoor's day-to-day operations. It doesn't tell you how many homes they bought, what price they paid, how fast they sold them, or how much profit they made on each transaction. No, this is a balance sheet move, a financial maneuver that, while huge, completely warps the company's real performance for the quarter.
Now, this table right here really shows the night and day difference between the headline story and the underlying reality. On the far left, you see the official GAAP numbers. That's the accounting standard that includes that huge one-time debt charge. And that's where the scary headline loss of $1.1 billion comes from. But now, look at the middle column. Those are the adjusted or non-GAAP numbers. This is the version that strips out that one-time charge to show you the ongoing performance of the core business. This is what professional investors, the big institutions, actually focus on. And as you can see, the adjusted loss wasn't $1 billion at all. It was only $62 million, or a loss of 7 cents per share. Now compare that to the Wall Street estimate on the far right. They were expecting a loss of 11 cents. So when you look at the operational numbers that actually matter, Opendoor didn't miss earnings. They beat expectations by over 30%. The headline was telling a completely false story.
Okay. So they beat a lowered bar on an adjusted basis. That explains the paradox? and that's fine. But that is not nearly enough to justify a 16% rally. Come on, a company can't build a durable long-term business just by losing less money than people thought they would. That doesn't forge a solid foundation. It just means the cracks in the wall aren't as deep as we feared. They are still a company that is burning through tens of millions of dollars every single quarter. So the real question now becomes, where is the actual strength? Forget the accounting beats for a second. We need to see real operational muscle. We need to see growth and a clear, believable path to actual profit. Let's see if the underlying business is truly being rebuilt with something strong.
And you're absolutely right to ask that. That question brings us directly to the heart of the bull case for Opendoor. The stock didn't just rally because of an accounting beat, that was simply the key that unlocked the rest of the story. The real reason for all this optimism is their operational pivot, this new strategy the company is calling Opendoor 2.0. This is where we get to move past the accountant spreadsheets and start looking at the actual engine of the business they are building.
You know, management isn't running from the problems. In fact, they're meeting them head on. The CEO, Kaz Nejadian, he put a stake in the ground last quarter. He laid out a very clear 4-step plan to transform the company's operations, talking about driving to break even, improving the profitability of every single transaction, and cranking up the speed on how fast they turn over their inventory. And his message this quarter was simple and direct. That plan we told you about, it's working, and we've got the data to prove it. Now, of course, talk is cheap, especially from a CEO. So let's ignore the words for a minute and inspect the evidence. Let's see if that foundation is actually being poured with concrete and steel.
Pillar number 1 for this turnaround is a 46% quarter-over-quarter increase in the number of homes they purchased. That is a massive number. You have to remember, after several quarters of pulling back, shrinking their inventory, and basically playing defense in a really tough housing market, this shows they are aggressively back on offense. They're scaling their operations again. It's the clearest signal we have that their new, more refined pricing models are actually working, letting them find and acquire the right homes at the right price at scale. You can practically hear the engine starting to rev.
But growth is worse than useless if that new inventory just sits on your books, bleeding cash every single day. That has always been the Achilles heel of this iBuying business model, getting stuck with a bunch of houses you can't sell. Now look at this chart. In the third quarter, more than half their entire inventory, a staggering 51%, have been sitting there for more than 120 days. That is old, stale, and incredibly expensive inventory. But this past quarter, they took a sledgehammer to that number, cutting it all the way down to 33%. This is proof positive. They aren't just buying more homes, they are moving them. They are efficiently clearing out the old, weak parts of their portfolio to make room for new, more profitable homes.
And this is backed up by a 23% reduction in the average number of days they hold a home. In a capital-intensive business like this, speed is absolutely everything. Every single day a house sits on their balance sheet, it's losing money through taxes, insurance, maintenance, the cost of capital, all of it. So increasing this velocity, making the entire system spin faster, is like injecting pure oxygen into the business model. It's powerful proof that the machine isn't just getting bigger, it's becoming fundamentally more efficient and a whole lot more powerful. So the evidence is clear. They're buying more and they're selling faster. The machine is running at a higher speed. But that leads to this single most important question. The one question that could bring this whole turnaround story crashing down. Is any of this growth actually profitable? Or is this just the classic doomed tech strategy of buying growth at any cost? Are they just lowering their standards, overpaying for houses, and then dumping them at a loss just to make the volume and velocity numbers look pretty for Wall Street? We need to see proof that this growth is being built on solid granite and not on sand.
And management knew this was the question everyone would be asking, and they came prepared with a very specific, very powerful answer. To prove the profitability of their new model, they put their October 2025 cohort of homes under a microscope. This is so important because it's the very first group of homes bought and sold entirely under this new Opendoor 2.0 system. It's their ultimate proof of concept. And the results? They're compelling. This group is on track to deliver the best contribution margins, that's the direct profit on home sales, for any October in the company's entire history. And what's more, they're selling these highly profitable homes at more than twice the speed of the group from October 2024. This isn't just growth for growth's sake. This is strong, profitable, high-velocity growth. This is the blueprint for the company's future, and it proves the model can work. Okay, so we've deconstructed the misleading headline loss, and we've seen the new Opendoor 2.0 engine fire up and prove it can run with both speed and profitability. So the final question becomes, can they sustain it? Can they take this one-month proof of concept and turn it into a durable, profitable fortress that can stand for years to come?
That brings us to our next section, forging a path to profit.
Now, let's look at their official guidance for the next quarter. At first glance, you might see that red flag at the very top. They're guiding for a 10% decrease in revenue. But Wall Street basically ignored this, and for a very good reason. Look at the other metrics. They're all improving significantly. They're projecting a smaller adjusted EBITDA loss, and most importantly, they expect their contribution margin to hit its highest level since the second quarter of 2024. What this tells us is that they are deliberately choosing to sacrifice some lower quality short-term revenue in favor of much higher quality, more profitable sales. They are building for strength, not just for size, and that's a sign of discipline.
And that discipline is also reflected in their public roadmap. They have clearly laid out their path to profitability for all of us to see and judge them by. They're telling us that their key metric, contribution margin, officially hit its low point in September of 2025. They're showing us with their Q1 guidance that the margin trajectory is already on the upswing. And they have put a big, bold target on the calendar for everyone to track. They are aiming to hit break-even on adjusted net income by the end of 2026. This isn't some vague wish. It's a transparent, step-by-step construction plan that gives investors a clear view of their entire strategy.
All right, we have deconstructed the earnings report, we've inspected their new operational engine, and we've reviewed their architectural blueprint for the future. We've seen the evidence, the good and the bad, so now it is time to weigh it all. It is time for the iron verdict.
Let's just summarize the bull and the bear case right here. The bull case is strong, and it's driven by hard data. The Opendoor 2.0 strategy is delivering real, tangible results. We're seeing that impressive acquisition growth, we're seeing fundamentally better unit economics with that October cohort, and we see a clear, credible path to their 2026 profitability target. But the bear case is still significant, and you cannot ignore it. This company has a history of absolutely gigantic gap losses. That near-term revenue decline shows there are going to be bumps in the road. And we can't forget the elephant in the room. Their entire business is incredibly exposed to the health of the broader housing market. One sharp downturn in prices or a spike in interest rates could throw this whole plan off the rails. The execution risk remains very, very high.
So here is the iron verdict. What we saw this quarter was the equivalent of a massive construction site that the market had basically left for dead, and suddenly it's roared back to life with new cranes, fresh concrete, and a much stronger blueprint. The operational turnaround is real. The Opendoor 2.0 plan is pouring a new, solid foundation for this company. The metrics on growth, velocity, and especially that contribution margin all prove that. But, and this is a huge but, the structure is not yet complete. They have poured the concrete and it looks strong, but the steel frame isn't up yet. The heavy lifting is still ahead of them, and they are completely exposed to the economic weather. The promise of what they're building is immense, but the risks have absolutely not gone away.
And so we leave you with this final question to consider for your own portfolio. The Opendoor 2.0 foundation is being poured, and the evidence from this quarter suggests it's the strongest, best engineered foundation this company has ever had. But is it being built with iron, capable of withstanding the inevitable storms that are coming in the housing market? Or is it still, at its core, a house of cards, beautifully built, but just waiting for the next strong gust of economic wind to blow it all down? That is the billion-dollar paradox that you now have to solve.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.